Welcome all you multifamily maniacs. I'm Dr. Heath Jones.
And I'm Hutch, the Marine Investor.
Today we'll be asking the question, how can cost segregation increase the profits from your multifamily real estate? Our guest today is the Regional Business Director of Madison Specs, a division of Madison Commercial Real Estate Services. Renowned for his knowledge in cost segregation, our guest is a sought-after resource throughout the commercial real estate industry podcast, and is now showing people how to crush LinkedIn. Not only does he save his clients tens of millions of dollars in taxes, but he also builds strategic partnerships in the marketplace, creating win-win situations for all. He is the host of the podcast, Weiss Advice, so make sure you go and check it out. He also has been a guest on dozens of podcasts discussing the details of the cost segregation process and the benefits for investors and owners of real estate. You can find out more about our guest and how he can help save your multifamily properties serious money by visiting madisonspecs.com. We'd like to welcome Mr. YONAH WEISS. How's it going today, sir? So glad to have you here.
Thank you very much. It's my pleasure. You guys, hope you're having a wonderful day and just trying to share some knowledge with you guys today.
Well, it's such a great way to start the day, you know, getting a dose of your daily knowledge right at the beginning. I love it.
But absolutely, we definitely appreciate it. It's been a long time coming, YONAH. I was first introduced to you by Brian Briscoe. He solicited your assistance with doing a cost seg on the property we purchased in Spartanburg, South Carolina. You know, so greatly appreciate that. You know, so YONAH, to dive right in, do you have a favorite real estate quote or mantra that drives you?
Quotes or mantra, so to say, it's not really a famous quote, but it's and it's not really a real estate quote, but it's something that drives me, and I think can drive a lot of people, which is, it's an old Jewish saying, a piece of wisdom, that who is a wise man? Someone that learns from everyone. So it's a question and answer. So who is a wise man? Someone that learns from everyone. And that's, you know, you can learn from some people how to act, you can learn some people how to do things. And so, but the open-mindedness to be able to learn from even the simplest person or any person you come in contact with, the point is to continually learn. And I think that's really what's driven me in my real estate career, and just the continued education.
Nice.
That's powerful. I like that a lot. Yeah, open-mindedness is a very important concept to wrap your head around when you're trying to learn more stuff as well. So
YONAH, can you tell us a little bit more about yourself and your current focus?
Sure. So actually been in cost segregation for the past 3 years, in real estate entirely for about 5 years. But before that, I was a teacher. I spent about 15 years, and really even before that, when I was I was in high school and as a teacher. And it's really my passion, more than a passion, just what I naturally do and what I naturally love is just to teach, to help others. If I know something, even if I'm not an expert at it, but I can teach that to someone else, I can help someone else understand that. That's what I enjoy. So that's kind of been my last, couple of decades involved with that. And at a certain point in time, the teaching profession was not paying that well, as most can imagine. And I thought, hey, I'd love to learn about real estate. I had a bunch of friends doing different things in real estate. So I just kind of jumped in, got my feet wet in commercial mortgages and then real estate brokerage, and just wanted to learn everything there was to know, which led me to my current job, which was kind of it was a strange occurrence, but I saw it like as almost divine providence. Just I was sent to this company, and I love it. It's an amazing company, Madison Commercial Real Estate, and we do so many things to help people across the country. And cost segregation is just one of them, but that's kind of become my expertise, just learning from the real experts in the industry who are, people who've been running the company for the past 15 years, and, just getting in and found this niche of just helping others and teaching them through these kind of mediums to save taxes.
The operators and the investors definitely appreciate that, because we all know Uncle Sam is going to get his, right? Or hers, whoever Uncle Sam is, right? The taxes is something that a lot of people think that we have to pay. You know what I mean? But what we like about real estate is that the government like that if you're providing jobs, you don't have to pay a whole bunch of taxes. And if you're providing housing, which we do, basic necessity, you don't have to pay a whole bunch of taxes, you know. So if we can save a lot of that, you know, just by educating yourself, I think that's amazing. So we appreciate that service.
Yeah, and I think you hit on something really important. A lot of people have this misconception, especially people in corporate America, that I'm obligated to pay taxes. You know, it's taken out of your paycheck, right? You have to pay income tax. But when you're in real estate, you realize that no, the money that you make, there are so many deductions, like we're going to talk about today, depreciation and cost segregation, that you actually don't have to pay taxes. Your money that you make, it's yours. And you don't have to give that away unless you're obligated to. So the way to kind of a mindset shift, a paradigm shift, if you will, that the money that you make is yours, okay? Taxes is something that you only have to pay if you have a liability, and real estate is one of the best ways to get around those liabilities, like you said, because the government wants to incentivize people for investing.
Let's start with a baseline understanding for our audience. Could you please tell us the basics of how cost segregation works?
We have to understand what depreciation is, which is a tax deduction. So depreciation is a tax deduction that the IRS says when you buy a property, you get to write off the entire value of that property, okay? So you buy a building for $1 million, you can write off that entire $1 million. Actually, if a certain amount is allocated to land, which does not depreciate, and the remaining amount, which is usually land, is usually 10, 15, 20% or so, but the remaining amount you can now take as a tax write-off, meaning deduct that from your income tax. Now, you can't do that all at once. The IRS says you have to actually spread that out over 27.5 years for multifamily or residential properties, and for commercial properties, it's even longer, over a 39-year period. So you're able to take about a 2 to 3% deduction each year from the value of your property, okay, which is about $20,000 to $30,000, depending on what that land allocation is going to be. That's amazing, okay, but that's what depreciation is. Again, it's the name is weird because you think about depreciation means something going down in value, but you have to understand it's just a borrowed term. It's a concept that the IRS says, since this thing is going down in value, or things do go down in value as time goes on, the IRS gives you this tax deduction to, you know, take that amount off every year from your taxes as if your property is losing money or going down in value, when in fact, most cases, your property is actually going up in value. It's appreciating as time goes on. And the reason why I say it's almost hypothetical, it's just a borrowed term, is because that depreciation deduction starts when you buy the property, the day that you purchase that property. And it doesn't matter when it was actually built. So if you buy a property built in 1935, but you buy it today in 2020 for $1 million, you get to take $1 million to write off. And guess what? If you sell that property next year, right, to someone else in 2021 for $2 million, now they get to take the $2 million as a write-off. So it doesn't really matter what the actual building value is. It matters what the purchase price, what you actually spent. That's depreciation in a nutshell. Now, cost segregation is like a more advanced form of depreciation. It says that, and it's just a weird name, okay, right? Like, I don't know why they gave this name to it, but it's just breaking down the name cost. You take the cost of the building that you bought and you segregate, you break down the building into different components. And in fact, it used to be called component depreciation, which is a much better term because it makes more sense. What we do is we look at the building, we send engineers to the property, and they determine every single detail actually has a different life. Not 27 years or 39 years. That's the main structure of the building has, you know, the write-off over that period. But you have stuff which is personal property or land improvements, which depreciate at a faster life. Okay, so personal property over a 5-year period. So the engineer is going to come and look at all the furnishings, all the movable parts, all the appliances, carpeting, things that aren't attached to the building, even though carpeting is, but it's considered 5-year depreciation, which means when you can add up all those things, okay, take all the cabinets and all the countertops and all the carpeting, the square footage of everything in the building, and you add all that up and depreciates on a 5-year, means you can write that off in taxes over a 5-year period, take that 20%, let's say, of your $1 million building, that's $200,000 as a write-off right up front.
Oh man. So why is it
Okay, I
important
know
for,
that was fast.
no, that's
I
fast.
think you hit all
So
the key components.
yeah, I was checking off my list. Okay, got this, hit that. Perfect. All right. So, Yona, yourself, you're also a real estate investor, right?
Correct.
Why is it important for investors and also operators, syndicators like Ethan and I, to understand cost segregation?
Well, no one wants to pay taxes, right? So,
Right.
I mean, obviously you want to understand it because you want to know if it's going to be applicable to you. Now, it doesn't, just because we describe this incredible way to get these tax deductions, it doesn't necessarily mean that, everyone's equal in getting that. And as a real estate professional, which is an IRS terminology, which says that if you spend more than 50% of your time in the real estate trader business, then you can actually use these depreciation deductions to offset all of your active income as well. Okay. Whereas if you're just a passive investor and you're not a real estate professional, then depreciation deductions and cost segregation, which creates huge depreciation deductions, can only be used to offset the income on your income tax from the investments. Okay. So the passive income from properties, that you can offset that with the depreciation. So you want to know about this because number one, when you're investing passively, then your investment essentially over the first 5 years, if you're doing a cost segregation study, in most cases, the money that you've invested, the returns that you get on that investment over the first 5 years will be, in most cases, tax-free returns, okay? Which means you're making, I don't know, let's say you put in $100,000 into a deal and you're making, it's favorable, $8,000, right? 8% return. Guess what? If you didn't have these depreciation deductions, that $8,000 would be taxed, okay? You're going to be taxed at your ordinary income tax rate, which is probably, 30, 35, 39%, whatever that is. You're only left with, $4,000 or $5,000, okay? But if you have that $8,000 and you have depreciation deductions, that means that's tax-free. You're actually, in many cases, get a loss. It will actually go into the negative, which means all of that $8,000 goes into your pocket, okay? Now, there are very few, if any, type of investment vehicles that I know of that are, income tax-free returns. So I think that's the most important thing to note for the passive investor. And as I said, the active investor, who's the syndicator or who's someone who's involved, they can use those huge deductions if they have more than it is to offset the income from the property. Then they can actually go ahead and use that to offset other income. If that's, any fees that they'd be making, if they're a broker, if their spouse is a W-2 worker and they're making, money from that, those depreciation deductions you can offset that and lower your income tax liability through those deductions.
And that's amazing. So you can actually make money, but actually and show a loss. That's like crazy concept to really fathom, right? And that's the beauty that we like about this opportunity or this great experiment that America is. You make money and you count as a loss through the cost segregation. Yeah, that's right. Amazing.
Right. Well, I guess it's based on the idea that, if you bought a brand new roof in 5 years, it's not going to be as new as it was when you first bought it. So in some sense, it's losing its integrity. It's losing the things that make it valuable. It's older. It's losing its value. So that's depreciation. And even though it may protect just as well as it did in year one, on paper, you're able to count that as a loss. And so that's why this is a very cool concept of looking at everything in there. So this is it's important for investors to understand this because, well, here's my question. I went into all my units, I assessed the value of every appliance, and I sent that to my CPA. So if they're brand new, I said they're brand new. I looked up what the market value for that item was. If it was kind of new, I reduced it by 80. If it was medium, somewhat new, if it was really old, I reduced it by 20%. And I made a little Excel sheet for all the appliances. And I sent it to my CPA, who depreciated everything as much as possible. Okay. Did I just perform a cost segregation?
In a sense, you actually did. But there are actually several different types of cost segregation studies. There are different approaches to doing it. So what you did was what's called a rule of thumb approach, which means you just took those, those values of those appliances. And the truth of the matter is that, you did it in the most accurate way that you could have done it as a consumer, as an owner.
That's right.
However, the IRS, talks about this in the Cost Segregation Audit Techniques Guide, which is how we get all the rules, how to do it. It discusses several different approaches. And the rule of thumb approach, for someone who's an individual and they have, appliances and things like that, and they don't want to take, the full engineering approach, then that's going to be, they have those numbers, they're going to have the receipts, like you said, to track that, the model numbers, etc. That can work for them, okay? However, if you want to actually maximize your benefit, especially if you have larger commercial properties, the engineering approach is the only one that's recognized. It's called a detailed engineering approach, and it's the only one that's fully recognized by the IRS. And really, it works both ways. It's a win-win, because in your approach, yes, you're looking at those appliances, but guess what? There's probably, dozens of other things in your property.
Yeah, after talking with you, after what you were saying earlier, I didn't know carpets. My CPA didn't tell me to get the flooring. He didn't say anything about the cabinets. There's a whole list. I could have depreciated way more items. I could have had a larger depreciation across a larger loss had I, gone to a cost segregation expert and gotten this information and had them do the engineering approach. So for the most part, there's a lot of things that you miss, right? if you're just trying to do it yourself. I have 23 units, something like that. So it was just something that my CPA was like, and this was before I learned about cost segregation. He was just like, hey, go get me the values, estimated values of this, and that way we can depreciate them. I'm like, all right. My CPA is not a real estate CPA, so I'm actually probably going to be looking for another one that's more real estate focused. But
I hope he's not listening to this.
I know, right? That's what I was thinking. Yeah. So, and when Heath and I, when we started partnering, that's one of the things that was important to us is identify those professionals. So our lawyer, he's actually a real estate investor, syndication lawyer, so on and so forth. So when we can speak very common lingo, so you understand, and he can also advise based on his experience, So
of course, absolutely.
Yeah, you're gonna have to find a new CPA guy.
just keeping it real. We're very open, honest, and transparent here at the Multifamily Real Estate Experiment Podcast.
That's awesome. But I think what you did was something that a lot of people who have, smaller properties, single families, and like you said, your CPA told you to do this, right? Now, in my experience, and we've done as a firm, like I said, I've only been with Madison Specs for about 3 years, been in business for 15 years, and the CEO and other of the executive members have been doing cost segregation for even longer than that, before they founded the company. What we've seen is that the majority of the question we get asked a lot is, why didn't my CPA tell me this? Or why don't people do cost segregation? Or how do people don't know this? And the answer is, guess what? Their CPA didn't tell them about it. Why not? Probably because either, first of all, it's a very small section of the tax code. And if you are not a real estate focused CPA, you just may not know about that. Like if you are a general practitioner, okay, you're not going to know about every nuance of open heart surgery and neurosurgery. And so too a tax code. The tax code is huge, it's massive, and that's why there are many different areas of the tax code where there are specialists who kind of specialize in different things. I wouldn't take, if I was a real estate professional and I know that there are so many tax deductions for real estate owners, I would want to have a real estate focused CPA because they're going to be able to maximize. and they're going to treat me, just like I would go to a doctor who was, specialized in that area. I would go to them. So that's what a cost segregation firm does. And most CPAs don't even know about it, to be honest with you. I mean, the big CPA firms do it in-house. Okay, so you have the big four and the big 10, the large CPA firms, they have engineers in-house to do this. The smaller firms, or individual CPAs, either they'll farm it out or they'll contact a third party, or they just don't know about it. So part of my experience is just
to go do it.
Or they ask the owner to go do it, which means they really don't know the first thing about it.
Yeah. So this cost segregation is a big deal. I was looking at a report on a $4 million purchase, which cost segregation was able to save over the first 6 years almost $1 million in taxes. That's some crazy depreciation right there. Right?
Yeah.
That's game-changing money savings right there. Seriously.
Yeah.
Yeah.
Right.
Exactly.
So typically, what percentage of the property is considered to be depreciable or depreciable?
Yeah. So like we mentioned, the first thing we do, right, is that the land does not depreciate. Okay? So you always have to allocate a certain amount to land value. And that's commonly found from your tax assessor or from an appraisal. And it's typically, depending on where you are located, what county, et cetera, it's typically between 10 and 20%. Okay, that's the norm, that's the average. There are cases like in California, in big cities in New York, where the land value is, huge, just because the value of that property is so much. It could be, literally up to 40, 50, 60% land value. When that happens, the building and what remains, that's the only amount that can be depreciated. Okay, so that's the first thing we look at. But then what we do is we break down that depreciable basis, is what it's called, that building, what's left over, into different categories. Okay. So the main structure, like I mentioned, the structural components, that's the main category. And then you'll have the cost segregation things like the 5-year property, personal, movable, tangible property, typically between 15 and 25% for multifamily properties. That category. Then you'll have the land improvements, which depreciates on a 15-year schedule. That includes landscaping, pavement, a parking lot, sidewalks, anything like that, fencing, any type of signage, any type of anything outside of the building, essentially, that's not part of the building. It still actually has value because it's not land, it's land improvements.
Right.
So you can, pave a new parking lot. Guess what? You can now take that as a 15-year depreciation. That's typically on multifamily properties, anywhere, depending on where it's located, if it's a garden style versus if it's a city property. Obviously, the city property has very little land improvements. Okay, you got the building and then, 4 feet and the sidewalks, and then the street.
Yeah.
That's it. There's not much there. Garden style properties, usually typically between, 5 and 10% is what's allocated to that. And other type of commercial properties may have larger percentages. So typically, we're talking about on a multifamily property, reallocation, this faster lives depreciation, 20 to 35%.
Oh man. So say there's an instance, okay, getting back to, I guess, my situation where, so say I started depreciation schedules for certain items. Mm-hmm. Would I be able to go back and do a proper engineered cost segregation analysis for 2020 that would then also provide me losses for the items that I didn't get in the first year of the 2019 or the first year of owning all my multifamily properties?
Yeah, there is a way to do that, to go back. It's called a look back study, which means you don't even have to amend your tax returns to do it. But what you do is there's a form, a 3115, a 3115 form that's filled out, and it's a change of depreciation, which means you may have taken certain depreciation beforehand, but going forward, we can now kind of recoup what the depreciation that was missed, that I could have taken in the previous year, and then go forward. However, there's one caveat. There's something called bonus depreciation, which we didn't touch on yet, but it's it was brought in the tax reform a few years ago, Tax Cuts and Jobs Act, which allows you to take all of that accelerated depreciation, that 5 and 15-year property. You can choose to take all of that in year number 1. which means that, 20 to 35% on $1 million property, you're talking about $200,000 in the first year as a tax write-off. If you already allocated certain things previously and you didn't elect the bonus depreciation, the one caveat is that going in the next year, you can no longer claim the bonus depreciation on that because you've already, allocated it and done the cost segregation and done a certain amount of it at that point. So you kind of miss out, you lose out on that portion. But otherwise, yeah, you can actually go back. There is another approach that some people, like to take. I mean, I have one big client who owns a number of hotels, dozens of hotels, and they were doing it, the cost segregation kind of on their own, kind of winging it, like your CPA was saying. There's, the CPA, they had a controller in-house and he was familiar with it, but he wasn't following any of the approaches that the IRS requires, including a report, which has, a whole numbering system and a whole, nomenclature. And there's a whole report. You have to show your work. You have to show pictures. You have to show, it's a whole study. I mean, our reports are, typically 80, 90, 100 pages long, very detailed, breaking down all those assets, the calculations, etc. This guy, he was just breaking down an Excel sheet, this item is worth this, etc., and depreciating. But he was really worried that they were going to get audited and that would fail an audit, and this is a multi-million dollar company, like I said, dozens of hotels. They're really worried. So what we ended up doing was kind of doing a cost segregation study as like an insurance policy, meaning the guy had already done all the depreciation and had already made all those allocations previously. We couldn't go out back to amend tax returns. We're not going to do that because that would just open up for an audit. But what we could do is say, here's this is what our findings were, and it's, pretty much in line with what your findings were, and therefore this is kind of the proof to back up what you had already taken. So there is that approach as well that I've seen happen.
So this brings up another question I had, because you're the perfect person to ask. So for the bonus depreciation, is it better to depreciate everything to its full extent in year one, or is it better to span that depreciation out over the period that you can depreciate that item for?
So you have the option. Before the CARES Act, which just happened last month, okay, I would always say it really depends. It really depends on your situation, and can you use those deductions? Is it going to be beneficial to you to get all those extra deductions if it's just going to be, put you in a huge loss? Okay. Now that the CARES Act took place, so that used to be my recommendation. Look at your situation. Is it going to be beneficial for you? Yes. If not, no. Because you have the option. Okay. Again, it's an option to do. You can do the regular cost segregation, or you can elect to take all those findings that you found in the cost segregation and take it all in year number one. Now with the CARES Act, they just made a new rule that allows for passive loss carryforwards to be 100% carryforwards, which they amended back in 2017. It used to just be 80%, which means in simple terms, if you have a passive loss, meaning you have $100,000 in income, okay, from your properties, and you have $200,000 of depreciation from the bonus depreciation. So your $100,000 stays in your pocket, okay, because that's your cash, no income tax liability on it whatsoever, and the extra $100,000 goes in like a negative bank account, like an imaginary bank account that carries forward, which means you can now use that next year. You don't get a refund. It goes forward, and you can kind of use that next year. Okay. Now with the CARES Act, they said you can use 100% of that, which means if you next year have $100,000 in income, but you only have from your regular depreciation, $20,000 of depreciation, so you still need, what are you going to do with the other $80,000 in income? You can use what's left over from last year, and you can use that next year.
That's great news. That's pretty.
That's just wild.
All right.
Yeah. So we got this. Saving a lot of money on taxes, right? And if we need to get somebody to do that, we call an engineer. What information would you need from us as the operator to actually perform that cost segregation?
So the first thing we always do is even do an upfront estimate, which is going to show you what your potential tax savings would be. For that information, we need very little information. For that estimate, we just need, the address of the property, the purchase price, the place and service date. Okay, so if it when it was acquired, the purchase date. If there was a 1031 exchange involved, we'll need what's the new basis, because when you do a 1031 exchange, we mentioned at the beginning that when you buy a property, your depreciation is based on what you paid for it. Okay, so $1 million property, you get to now write off the $1 million. But when you do a 1031 exchange, your basis carries over from the last property. So as part of the rules that since you can defer the capital gains, you defer the depreciation recapture tax from that sold property, you just carry over. So whatever that is, if you already depreciated a bunch, whatever's left over, that's what's your basis on your new property. So we need to know that. If you're doing major renovations or a big, rehab project, we'd, like to see a construction budget, because that will tell us what the benefits of doing the renovations component will be as well. Once we have that, we'll do an estimate, and then the real cost segregation, that's much more in depth. Engineer will come to the property, take pictures, measurements, survey basically the whole property, walk the property, and then come back. We need from that, we'll need the appraisal and, et cetera, just to be able to get that information and come back and create that report.
How small of a property can you go? I mean, would you do a cost segregation for, say, a 4 or 5 unit? I have a 16 unit, a 4 unit. Is that something that cost segregation would help? Is that something that different firms would take on since it's so small, or is it just mostly larger properties that this works for?
It's more based on the purchase price than it is the unit count. Okay, so you can have a single family property because, again, it's all proportions. Okay, it's percentages. So my rule of thumb is anything over $1 million purchase is like a no-brainer. There's so much there, it's ridiculous. Under $500,000, I say it's usually not worth it, depending on the situation, just because the amount of depreciation that can be had is, there's obviously a fee involved in the process, which is a flat fee. It's not contingent on the savings, but nevertheless, it's still something you have to, weigh that out and see what those benefits are going to be. So again, if it's a 20% reallocation on a $500,000 property after the land, land deduction, you're talking about maybe, $70,000, $80,000 of extra depreciation over a 5-year period. Now so it can work. There are definitely firms that do that. We typically try to just, want to provide the most value for our clients as possible. So we typically recommend only on larger properties where you're going to get the value. That being said, it also depends on the individual. It depends on what their portfolio is. Okay, I spoke to someone yesterday and they have, a 12 unit and an 8 unit. And they're like, we also have a bunch of single families that we bought for like $50,000, $70,000 each. Is it worth it to do that? I said, listen, you do the cost segregation on the 12 unit that you bought for, $1 million, you're going to have enough depreciation. It's going to spread across your whole portfolio, meaning the depreciation that you get spreads across and allows to offset the income from your whole portfolio because it's your income all across the board. So you don't need to do it necessarily on a smaller property when the benefit is not going to be there.
Hutch, you're muted.
Got it. So in the years of doing cost segregation, what is the best savings have you seen so far?
Oh man, the best savings? We did an RV park last year, okay? Now, an RV park,
that's a weird one.
There's nothing there because there's no building. I mean,
Okay.
the guy, it was like, I don't remember how many acres it was, but it was just like they had a small building, which was like an office and a laundry room. And then everything else is just pavement, okay? But the pavement, guess what? That's called land improvements. Now, land improvements, if you remember, depreciates on a 15-year schedule, which is also eligible for bonus depreciation. So listen to this. And the land value in that place, it was like worth nothing. The land, it was literally like 0.008% or whatever, the land allocation. It was in the middle of nowhere. The guys literally bought this property for about $3 million, okay? Took like $2.8 million of a first-year tax write-off, okay? Because 92%, And I don't remember if the numbers were exactly right, but 92% of the property was allocated to the land improvements because the purchase price was just the land, just that. So that was probably the best. I mean, literally 92% of the purchase price going to bonus depreciation. That was huge.
Wow.
That is insane. So that's the cool thing about real estate is that we can use leverage, right? So the bank controls
Exactly.
is financing about what, but between 65 and 90% of the purchase price, but we can depreciate almost 100% of that. That's a game changer. That's the beauty about real estate, man. It's super fascinating, super exciting, and it's a great place to be. So now cost segregation is definitely something that we love and appreciate that the governments afford us to do.
Oh man. So got anything else, Hutch, or should we hop into the focus round?
Yeah, we can do the focus rounds, and then we can dive into. We'd definitely like to pick your brain about LinkedIn, if that's possible. So that'll lead us in our focus round. What do you do for fun, Yonah?
Fun. Well, as I said before, I have 6 kids, so that's all the fun that I do. No, I just hang out with them. I actually love to go out in nature. So if I get a chance, just go out into the hills, the forest, mountains, whatever it is, and just kind of take some time to myself. And that, for me, that's fun.
I think it's very important to do things like that as well. So that's pretty cool. All right. Opportunity. What is one opportunity that was a game changer for you?
The first time I was ever invited to be on a podcast, which was about 2 years ago. It was by Adam Adams, the creative real estate host. Amazing guy. Subsequently, I've been in touch with him a tremendous amount and met him in person. And he invited me I'd never done a podcast ever. Okay. And he was like, yeah, I'd love to interview you. I'm like, I don't even know what that means, but I literally, just jumped on the opportunity. And since then, I've been on over 80 podcasts interviewing this, and it's just been incredible. So I think it's a huge opportunity.
Oh, man.
Nice. So what would you say is your most important communication tip?
Think before you speak.
Okay, let me do it again.
No, I didn't mean that to you. No, I'm just kidding.
No, I'm not just messing. No, just messing with you. That's one of the things we like about the show is that we can laugh and talk with our guests. You know what I mean? Every too often we see where relationships are so transactional, and Heath and I, we strive to create lasting relationship. And I think laughter it takes relationship to a different level other than just transactional, So,
absolutely.
All right.
But yeah, think before you speak.
Think before you
I've been
speak.
told that on more than one occasion in my life now. So. All right. Understanding. What is one thing you wish you understood earlier?
One thing I wish I understood earlier was finances. It's a kind of broad category, but when I was growing up, I didn't have a big appreciation for money and how it's spent and how to save and etc. So that wasn't taught to me very early on, at least not as in depth as I understand it now. So that's one thing that I wish I understood earlier.
That's great. That seems to be a common theme amongst a lot of adults. So all we can do is you got 6 kids. That's your sphere of influence. Pass it down real early. Heath and I were doing the same thing as well. So, yep, understanding finances.
It's like it wasn't until I was 36 before I even came across the book Rich Dad Poor Dad, and it's just like, great. Where was this 20 years ago?
100%. They should teach it in school. It should be mandatory.
Absolutely.
Reading material.
Yeah. So, to what do you attribute your success?
Everything is, I attribute everything to God. So meaning, we put in our efforts, but I don't control the fact that I breathe and I'm alive and I have, mental abilities, and all of that comes from, a force greater than me. So whatever you want to call it, but I'm a very, big believer and in that, we can't really do anything on our own. And, if we didn't have that the power, the ability, the capabilities that are beyond us, then we really can't do anything. So that's why I attribute all success.
Yeah, I was reading a book by I think it's Osho, that talks about intuition, and it's amazing that you bring that up. It's like something magical that goes on that no human being can really on this comprehend or really explain how it happened, why it happened, all the good stuff. And I guess we can form our own interpretation of it, but definitely understand that there's a supreme being that controls all these things that we cannot control on our own. I think that's amazing.
Absolutely.
Yes,
All right. Well, Yonah, if our listeners wanted to get in touch with you, how would they go about doing that?
You can find me on LinkedIn. That's the best place.
Are you on that platform, by the way?
I've been a few times. Been there. If you want to, reach out to me, my email is yweiss@madisonspecs.com. So that's first letter of my first name and last name. Phone number 732-298-9002 if you want to get one of those free estimates on a property or you just want to reach out.
Excellent.
Sounds great.
Well, Yonah, thank you so much for taking the time today to speak with us and walk us through this money-saving process and help instill that passion for finances and the understanding of this part of the tax code that a lot of people don't understand and may not have access to. So hopefully our listeners get a good sense of the power that cost segregation has on ultimately how much take-home money you have from the income from your property. So we really, really appreciate you coming on today.
Yeah, we definitely just what he said. And additionally, leaving cost segregation to the experts, right?
Yeah, that's right.
Definitely, that's the best way to provide value for the operators and also to our investors. So letting the expert be the experts.
Yeah, don't go to a plastic surgeon to get your heart surgery done.
Yes, sir.
All right. Well, thank you again very much. I'm Dr. Heath Jones.
And I'm Hutch the Marine Investor. Out. All right, so we keep recording, and we definitely like to, if you got a few minutes to talk about
Sure.
Maximizing LinkedIn, and we're still recording, just so you know. I think this portion we can chop and we can send it to you before we even publish a podcast. And something we could speak directly to our audience, your audience, Ethan and I's audience on LinkedIn of how to best capitalize on LinkedIn. Is that something you're willing to do?
Sure. I'm all for it.
Yeah. Okay. All right. So Yonah, we connected on LinkedIn, man. What is the secret sauce for maximizing networking on LinkedIn?
I think it's like, the opportunity of LinkedIn is that you can access anybody, okay? But it's social media. So I think of LinkedIn like a 24-hour networking event, okay? And when you have to really think of it like that, okay? But there's different levels of being at a networking event. If you want to meet someone new, you're not just going to go right up to them and tell them, what you do and how you can, pitch them or whatever it is. That's just not what you do. You meet people, right? And you hang out and you see what other people are doing. But there's something even greater about LinkedIn, which is that, and if even on using that networking event analogy, is that it's a business platform, meaning it's a business networking event and it's professional, which means people are very positive overall. Okay, people are professional overall. Obviously, there are exceptions. And people are looking to do business, which means you can find those people that you're looking for, and they're going to be much more receptive at the right time if you approach them, through LinkedIn. So when you go ahead and go post content on LinkedIn, you want to make sure that you're doing it in a way that is appealing, but it's also using and understanding the algorithm and understanding how this social media platform is different than all other social media platforms. Okay, so it's not enough, if you really want to maximize it, it's not enough to just post something from a third party, posting app or whatever it is that will just syndicate all your posts to 10 different platforms, because you're not going to have the nuances that will make your posting get seen and be engaging specifically on this platform. And that's one of the mistakes I see a lot of people doing.
Yeah. So you're saying that if I want to connect with somebody, I should not just blast them my company info and my bio and stuff. No.
No, obviously. I mean, but
Yeah.
you think about it. Think about it. People do business with people that they know, like,
Yep.
and trust.
That's right.
But number one, if you're not there and you're not engaging, you're not involved on the platform, no one's going to know you. Number one. So you got to post. You got to engage with other people's posts, which means liking, commenting, leaving thoughtful comments on other people's posts. And I think that's even more powerful than posting your own original content, believe it or not.
Nice. Yeah. So I kind of like follow your concept is that you know who you want to speak to, especially those relationships that you've already created that has a larger following, right? Or a large following. Tag their name inside there, and now they're seeing this post, they're commenting, their network is commenting as well. So your post has been super successful, and I've been tracking a few of them, so I really appreciate that. So
Yeah. For our listeners, they may not have seen, but there was over 1,000 views of your profile in a week. I saw someone else post that about your profile, and they're like, "This is how you get it done."
I think he was posting that was his profile.
Oh, it was his? I thought it was for yours.
No, he posted his, and he was just saying that since I've been involved, with YONAH or whatever, that this is what's happened.
Gotcha.
How he's blown up.
Yeah.
But mine is like 2, 3, 4 times that amount.
Oh wow.
Who's counting, right?
Yeah,
Yeah. So you said ever since being in YONAH, are you also a coach for coach or any sort for social media management?
No, I'm not.
Okay.
I just do it for fun, and I just like to help people. So happy to share I've been doing it consistently for the past 2 years or so,
Right.
and I've had a tremendous amount of success from it. So I just enjoy sharing my experiences with others.
Got you. All right. So you want to tell us about your event coming up with Dan?
Sure. So we started a virtual real estate investing networking event, basically. So, we can't go out now with COVID and the quarantines and, the stay in place orders. We can't go out and meet people, or if we can, it's, few and far between. So what we created is a virtual meetup. Okay. And this is going to we're going to be doing this every Wednesday night at 7 p.m. Eastern Standard Time. And you can check out my LinkedIn for my business page, the Real Estate Connections virtual meetup, to sign up and register for the upcoming events. There's 2 things that are going to be happening at this. Number one is we're going to have a guest speaker every week, someone who's an expert on a different topic. So this week we have Dan Hanford, who is a very famous syndicator, and he experienced in passive investing as well. And he's going to be talking about the red flags of investing in a multifamily syndication. So that's the topic he's going to be talking on. And the second thing that's going to happen, which is a really cool feature that Hutch and I were on last week with Brian Briscoe's event, that he broke up the Zoom meeting into little breakout rooms, which is super cool. So we're going to do that. We're going to break out into networking rooms, like break up the 100 people into groups of 2, 3, or 4. And so you can do a little private Zoom just like this and get to know people on that level. And we're going to do that a few times, a few rounds of that. So that's going to be a lot of fun.
Yeah. So if you're watching this and you're thinking that you cannot network because we cannot get together, I'm telling you, what a lot of these syndicators are doing, or these networkers are doing, is with Zoom, those breakout rooms are a game changer, right? You get to talk to 2 or 3 people, 2 to 5, usually about 2 to 5 people, and you can get some valuable information. You can create some great relationship that you can follow up with after the Zoom call. So it's not just one big blast, everyone on the screen trying to speak over each other. That's not the case.
Right.
You get to go in a little room, virtual room, I guess, get virtual room and talk
Right.
about your needs, your wants, you have all the good stuff, and talk about your why, talk about what you're working towards, talking about the struggles that you're having. And before you know it, you are solving other people's problem. People are helping you solving your problems, so on and so forth. And it's a game changer. So if you have 1 hour during lunch and there's a lunch hour, there's a lunch networking session going on Zoom, please definitely join it because it'd be a game changer for you.
Absolutely.
Right.
Yeah, I think we should maybe like chop this little 10-minute part up and like push that out as soon as possible.
So that's what I was telling Yona about. We definitely will chop it off. I'll put it into. It's really easy to put it into iMovie, and chop it out and send it out to yourself and Yona.
Okay.
Right. I'm pretty sure Yona gonna do a lot greater things with it than we would. All right. All right, Yona. Is there anything we didn't ask you, Yona, that you feel would be valuable to our audience? Things you're working on? No.
Yeah, I mean, no, I think that's it. We're, working on our podcast, also Weiss Advice, and I think, you mentioned that earlier. But yeah, check it out. Check me out on LinkedIn. Please connect. If I can help in any way, don't hesitate.
Excellent. All right. Oh man. Well, this has been great. I've learned a lot. As I said before, there was a lot of things I didn't understand about cost segregation, and it wasn't until I saw the power of it in my own tax returns where I'm like, well, I could have gotten more. And so I really want to capture that and pass it on to the audience so that they can feel the power. Hopefully we did that today. I don't know. What do you think, Hutch? You're on mute again, buddy.
My dogs were kind of whining earlier, so I didn't record it. Yeah, I had a lot of notes that I were hoping to cover. Kind of hit on 1031 exchange as well too.
Yeah, I thought that was a great point. I don't know how common it is to know that all the depreciation you took on one property carries over to the second property. So I think that was a very insightful point that I hope people pick up on.
Yes, sir.
Okay.
Yona, we greatly appreciate your time. We had it for about an hour, right at an hour.
All right.
Yes, sir.
Okay. Well, you guys enjoy your day.
Okay.
And we'll talk to you soon. Hopefully, I hope to see you guys on Wednesday or tomorrow.
Absolutely.
Tomorrow.
Yes. I actually got a day off tomorrow, so yeah, I'll be there. All right.
Yeah.
You take care, my brother.
Okay,
Awesome.
guys.
All right.
Bye, guys.